Doesn't matter what the broker says to you. It's a whole load of bollocks. And there is a stronger word I could use, but I'm not going to, because there might be children listening to this video, or some people might take offense. So the broker's saying you can trade $100,000. All you need to do is put $1,000 in your account. That's what's called 100-to-1 leverage. Now, some brokers will even offer 200-to-1 leverage. Any of these numbers is completely ludicrous. All you've got to do is to take one bad trade and your account's wiped out, or you've had a margin call. So some brokers will say, hey man, you've got $1,000 in your account, I'll let you trade $200,000. And imagine the amount of profit you can make with $200,000, they're saying. Well, that's quite true, but as I said, all you need to do is to take one losing trade of 30 or 40 or 50 pips, and you've got a margin call and your account's wiped out. So that's what leverage means. Whatever's in your account, the amount of leverage, 10-to-1, 100-to-1, 200-to-1, you simply multiply your account balance by that number, and that's the amount that you will be allowed to trade. So I want you to ignore all of that. Forget what the broker says, 100-to-1, 200-to-1, 50-to-1, whatever your broker offers you, completely ignore that. I'm going to tell you really what you should be doing. So let's keep on the subject of leverage, and let's talk about what you should be doing rather than what the broker says you should be doing. Right, now, what I would suggest to you as a rule of thumb is to use 5-to-1, no more than 5-to-1, or maximum 10-to-1 leverage. That's what I'm suggesting to you. You can use 5-to-1 or maximum 10-to-1 leverage. You can see how small that is in comparison to what the broker's offering you, 50, 100, 200-to-1. I'm saying don't go more than 10-to-1. If you do that, you're a fool. You will lose your money. The Bible says a fool and his money are easily parted. If you go more than that, you'll part from your money pretty easily. And I don't mean any disrespect by saying that, but it's really the truth. Now, let's have a look at this in a little more detail. Let's go again back to the $1,000 account example. Now, if you're trading at 5-to-1 leverage, and this is a decision you make yourself, it's something that you control completely. So you've got $1,000 in your account, and you say to yourself, man, I'm going to be trading at 5-to-1 leverage. And therefore, you take your account balance, you multiply it by 5, and that gives you your position size. It's really as simple as that. And in this case, your position size is $5,000, and every time you take a trade, your position size is $5,000. That's half a mini lot. Half a mini lot. Or if you're trading a micro account, it's whatever it is, I don't know. But it's half a mini lot. That's 5-to-1 leverage. If you decide, and I would suggest you only trade 10-to-1 leverage, if you're experienced, confident, practiced, same thing as experienced really, you've traded on demo before and you've got used to the system, you have a trading system which you trust, for example E75 or TNT, whatever, only trade up to that leverage if you're experienced, confident, practiced, you've traded on demo, you've got used to the system, trust the system, and so on and so forth. Then you can go to 10-to-1 leverage. If not, stay at 5-to-1 until you're consistently making profits. Now, if you're going to be trading at 10-to-1 leverage, again, you take your account size of $1,000 and you multiply that by 10, and that gives you a $10,000 position size. That's one mini lot, and that gives you 10-to-1 leverage. And really, that's all you need to know about leverage, about margin, about lot size, etc., etc., etc. All of the noise and hype out of there with what the broker's offering you and margin and leverage and what it means and what it doesn't mean. All you need to know is you shouldn't be trading more than 5-to-1 leverage if you're not any of these things. If you are experienced, confident, practiced, you've traded and tested your trading on demo, you've got a system that you trust, then you can go to 10-to-1 leverage. This is not advice. I am not saying to you, you should be at 5-to-1 or 10-to-1. I'm not saying to you, you should be at anything to 1. But I'm saying, this is what I do, this is my approach to it, And if you're going to go more than 10 to 1, I would suggest that you're looking for incredible danger and difficulty in surviving in the Forex market. All right, so now why do I choose these numbers? Now this is really important, and I'm going to go on to the next thing. And as I said, leverage and risk percentage are very, very closely linked and very important to understand. Now, again, please listen, scroll back in this video, rewind it, listen again, rewind it, listen again, until this is inside your head, right in there. Get it inside there, this concept of leverage, and do not break these rules. All right? Get it in your head. It's really important. If you don't understand it, rewind, think about it, rewind, think about it until it's inside there. Now, I'm going to say why these numbers are important, 5 to 1 or 10 to 1. I'm going to give you the reason, the exact reason why I've chosen those figures, and the reason has got a lot to do with risk percentage. So let's put that up on the screen, and let's talk about risk percentage. And I'm going to discuss this now in some more detail, but before that I'm going to take a little break for a glass of water. Right, that was quick, wasn't it? In fact, it was about 10 minutes, but for you it seemed to be instant. So let's talk about risk percentage. Risk percentage. That's the way we say it in South Africa, risk. And it's pretty similar in New Zealand, risk. Whereas in England or anywhere else you might say risk. But you understand what I mean. It's the amount of money that you put on the line every time you take a trade. So when I say I'm risking 10% of my account, that means if I lose the trade, then I've wiped out 10% of my account. If I'm risking 2% of my account, that means if I lose the trade, I've lost 2% of my account. So if again we can go back to the $1,000 scenario, and if I lose 2% of that, that's $20. So let's say I've taken a trade, I've lost 2% of that account. In other words, the trade's closed out for a loss, I've been stopped out, and I've lost 2% of my account. That means I've lost $20 out of my $1,000 account. Now that doesn't look like very much. In fact, most of you will be saying, well, you know, that's a very small risk. I can risk a lot more than that. But let's say you lost 5 trades in a row. 5 times $20, suddenly you've lost $100 out of your account, and that's 10%. So don't be misled by these apparently small numbers of losses, because don't forget, you can take more losses in a row than you might expect. So risk percent is the amount of money, don't know where that came from, but risk percent is the amount of money that you risk on each trade. Now, from experience and from general wisdom out there in the marketplace, and from the point of view of emotional aspects of trading, in other words, the emotional impact of losses or gains, from all of those points of view, I would suggest to you that you don't want to risk more than 2 to 3% of your account on each trade. So in other words, if you take a trade and you have a stop loss, and I want to really emphasize the stop loss a little bit later on, but if you have a trade and your stop loss gets taken out, you don't want to risk more than 2 to 3% of your account. That's as simple as that. And as I said, that comes from my own experience, comes from conventional wisdom out there in the marketplace, not only Forex, but stock markets and futures and options and all sorts of things like gold and commodities. You should not be risking more than 2 to 3%. And also, it keeps you sane. As long as you know that if you have a loss on your trade, and it's only 2 or 3%, then generally you're not afraid to take the trade or to take the loss. If it's more than that, you're sometimes afraid to take the trade, and more seriously, if the price approaches your stop loss, you're very often tempted not to take that loss, and you might be tempted to move your stop loss further away, or add to the losing trade, or even try to recover your losses a little bit later on by so-called revenge trading. So we don't want to risk more than 2 to 3% of the account. Now, the other thing I want to point out, which goes hand in hand with this, is most of the time, with the sort of trading that we do in E75 and TNT, most of the time we'll be trading with something like a 20 to 40 pip stop loss. Right. Now, we can tie these two things up. In fact, we're going to tie these three things up: leverage, stop loss, and risk. We know that we don't want to risk more than 2 to 3%. We know that our stop loss generally will have to be 20 to 40 pips, so that's constant. That we can't change. The stop loss, generally, we can't change. We don't have a lot of control over that. So that's a constant in this equation. But the leverage is up to us. We can adjust that, as I said earlier. And the consequence of the stop loss, which is more or less fixed, in other words, the trade entry signal will tell us what the stop loss needs to be. The combination of the stop loss and the leverage that we choose, so we're in complete control of that, gives us the risk percent. So that's the equation. It goes this way around. Stop loss, which is fixed more or less, plus the leverage, or multiply by the leverage, in fact, gives you your risk. So let's put that little equation. Stop loss times your leverage is equal to risk percentage. Now we're really getting into heavy maths here, aren't we? No, not really. It's very, very simple. You know what the stop loss is from the E75 or the TNT entry. You know what the leverage is, and I've suggested no more than 10 to 1, and you can go down in increments of whatever you want, down to about 5 to 1. You could even go lower than 5 to 1, but I'm suggesting no more than 10 to 1. That's a number that you fix in your mind and you determine. So you know what your stop loss is, you know what your leverage is. Remember, whatever your leverage that you choose, you multiply your account balance by that much, and that gives you your lot size, and the combination of those two will give you a risk percent. Let's give you an example. Let's say, let's say we've got a $1,000 account. All right. Let's say on the trade that we're looking at, the trade entry, we need a 30 pip stop loss. Let's say we're not willing to risk more than 3% of our account. And let's say we want to determine the leverage that we want to use. What is the leverage? All right, so this is how it works. I need to gather my thoughts here because I'm rattling through this rather quickly. Now, a rule of thumb, if you have a $1,000 account and you have a 30 pip stop loss at 10 to 1 leverage, that'll give you a 3% risk. All right? So let's just put this very simply. If you're at 10 to 1, I'm assuming that we've chosen 10 to 1, whatever pip stop loss you have, so you take the pips and you divide that by 10. Sorry, that shouldn't be 10. We just divide the pips that you risk on the stop loss, divide that by 10, and that's equal to your risk percent. That's if you've got a 10 to 1 leverage. All right? Very, very simple. If you've got a 5 to 1 leverage, then you take your pips, you divide that by 20, and that gives you your risk percent. It's as simple as that. All right? So let's take these two examples. We've got a 30 pip stop loss. We're at 10 to 1 leverage. And so in this case, we've got 30 pips divided by our leverage, which is 10, and that gives us 3%. In this example, assuming the same stop loss, we've got 30 pips divided by 20, and that gives us a 1.5% risk. All right, so you can work it out for 6 to 1, 7 to 1, 8 to 1, 9 to 1 leverage. It's quite simple. It's the same sort of formula. But basically, I would suggest either going 5 or 10 to 1. You might choose to go 7 or 8 or 7.5, whatever you want. But these are the two main ones that I would consider for you to use. They're very, very simple. And let me give you one more. Pips divided by 100 is equal to risk percent. Let me just put this here. This is 10 to 1 leverage. This is 5 to 1 leverage. And this is 1 to 1 leverage. Pips divided by 100 is equal to risk percent. So once again, if you've got 30 pips, you divide that by 100, and that's equal to 0.3%. And when I say 1 to 1 leverage, that means if you've got $1,000, this is 1 to 1. I know it's getting a little bit higgledy-piggledy, but when I say 1 to 1 leverage, that means you've got $1,000 in your. If you've got $1,000 in your account, you're trading $1,000 lot sizes only. So it's 1 to 1 because your lot size is the same as your account size. If you're trading 5 to 1 leverage on a $1,000 account, then you have a $5,000 lot size. And if you're trading 10 to 1 leverage on a $1,000 account, you have a $10,000 lot size. So it's very simple. You can work out what your account balance is, and you can work out the leverage, the risk percent, and so on and so on and so on for yourself. It's not complicated. It's quite easy, and that's the way it all works out. Now, let's see if I can remember number 4. So the first thing we talked about was no-brainer. No-brainer trades. And remember, that means a tiny stop loss. Tiny stop loss or dramatic reversal. The second thing we talked about was leverage. And I suggested don't go more than, in other words, make your leverage less than 10 to 1. And less than 5 to 1 if you're inexperienced, unconfident, don't have a system, or don't have it nailed down properly, you haven't traded on demo, etc. The third thing we talked about was risk percentage, and I did say there was a fourth one, but I can't remember what it was. I think it was something to do with a stop loss size. So stop loss size. And generally our stop losses are going to be between 20 and 40 pips. And so if we're using 10 to 1 leverage, generally our risk will be between 2% and 4%. I always want to be closer to 2%. I don't like to go more than 3%. I'd like to have no more than a 2% risk. And therefore, if I can get in at 1.5, 1.2, 1.7, 2, 2.1% risk, that's the type of trade that I like to take. And so on. I've just remembered what the other thing is, and that is risk. So we've got 5 now, risk reward. And I have covered this in other videos, but I'm going to deal with it specifically in this case because it's a very important part of risk control and risk management. I want to say one thing before we go across to that, and that is never have a stop loss which is too big. Never, ever, ever have a stop loss which is too big, and therefore a risk which is too big. And never trade without a stop loss. Never trade without a stop loss, ever, ever, ever. Just don't do it. And never move your stop loss or add to a loser. Never do that. 3 nevers. Never have a stop loss which is too big, never trade without a stop loss, and never move your stop loss or trade with an extra position size and add to your losing position. If you do that, do any of those things there, you haven't got this into your brain, and well, that's all I'm going to say about that, because you won't survive as a trader. Alright, so now I'm going to talk about risk reward, and again, this is a pretty important part of trading. Now, what risk reward means, and it's always written really the wrong way around, and I prefer to call it reward to risk. And I have covered this in previous videos, but I want to highlight this again now. And the bottom line here is, whenever I risk something, whenever I risk money on my trading account, I always want the upside to be greater. In other words, I want the reward always to be greater than my risk. And I think I've covered that quite adequately in other videos, but I'm going to give you a little example. The reason for this is because, let's say I have 2 or 3 losing trades in a row. Let's say I've lost 2% on each trade, and I've lost times 3 trades, I've lost 6% on my account. And what I'd like to be able to do is not to take 2 or 3 trades to recover that. I would like to recover that all in one trade. For example, I'd like to be able to cover that in at least at least 2 trades, maybe 3 trades, but sorry, at least 1 trade, maybe 2 trades. But I don't want to have to take 3 trades to recover that, because it just means that I'm going to take 1 step forward, 1 step backwards. And particularly if I'm not an experienced trader, sometimes you'll find you'll win 50% of your trades and you'll lose 50% of your trades. And I'm not going to go into the percentage winning ratio of the system, because now we're starting to get complicated. But just remember, I want the upside, the potential reward, the potential profit on the trade to always be greater than the risk I'm taking on the trade. Now I'm going to give you one example of this, and then I'm going to finish this video off because it's getting rather long. Let's say, just let's say, that every time we take a trade, we risk 20 pips. Okay, every time we take a trade, we risk 20 pips, and every time we get stopped out, we've lost 20 pips. But every time we win a trade, and this is very simplistic because it's not always going to work out exactly like this. In fact, it very often doesn't, but the principle is what we'd like to adhere to. Every time I win a trade, I win 40 pips. So in other words, whenever I get into a trade, I make sure my stop loss is no bigger than 20. And I always make sure that the potential for the trade, or my target for the trade, is always 40. That's a very, very simple example. But I want to take an example where now, given that scenario, we have 10 trades. We've taken 10 trades in our system. And either the system's not very good or we're not very good at trading. But out of those 10 trades, we win only 3 and we lose 7. Let's do this like this. We win only 4. Well, let's make it 3. We win 3 winners and 7 losers. Let's have a look at the overall result of those 10 trades. Well, we've got 3 winners, so we've got 3 times 40. So on those 3 winners, we've made 120 pips. And we've got 7 losers, so that's 7 times 20, and that gives us 140. And so overall, we've only lost 20 pips. And we've lost most of the trades. We've lost 7 out of those 10 trades, but we end up with only 20 pips loss. Now let's have a look at this a little bit, with a little bit of a twist to it. Let's say on every trade we only, now my maths is going to get difficult here, but let's try it. We lose only 18 pips, but we win 42 pips on each trade. That gives us about a 2 to 1, 2.2 to 1 reward risk ratio. And let's use the same scenario. So we've got 3 winning trades times 42. Let's work that out. Another 3 2s are 126. Is that correct? I think so. And we've got 7 losing trades. So we've got 7 8s is 56. So I'm going to have to do it like this. 7 times 18. And I do it the old-fashioned way. 7 8s are 56. Carry 5. That gives me 126. Well, there's a good example. I didn't even know it would work out like this. And that gives us break even. Okay, so we've risked 18 on losers. We've gained 42 on winners. We've lost most of the trades. 7 out of every 10 trades we've lost on the trading system. Means we're either pretty bad traders or our trading system sucks completely. But after all of those losses, we've actually ended up with no overall loss on our account whatsoever. The reason I'm telling you this? Risk-reward ratio. Always make your risk around about half of your anticipated, projected, targeted goal. So if you're risking 20 pips, always trying to go for 40 pips on the trade. If you're risking 30, always try to go for 60 pips on the trade. That's a general principle. It's not going to work out like that most of the time in real life, but you might often get stop losses smaller than 20 pips with a bigger target, or you'll get stop losses bigger than 20 pips with a smaller target, but that's the general principle.